On this week's program, we're going to talk about the 10 truths of presidential elections. No matter who wins, there are some certain truths that ultimately always ring true. We hope you'll be curious on those, especially as we get closer to the election. Less than 3 months away, expecting a vice presidential pick out of Biden in the next week or two, so should be an interesting time. Plus, we'll also talk a little bit about the tale of two cities, if you will, that exists in the market these days. The reality is you've got some companies that have been doing very, very well and others that haven't, and what you should be doing as an investor to help make sure that you're where you need to be. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on Sunday mornings on the WFLA network and also 96.9 The Game. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web, thanks to an accolade given to us at the beginning of the year by the folks at FeedSpot. We've got over now it's over 11,000 downloads of our podcast. So we certainly appreciate our podcast listeners out there as well. My name, of course, is Joel Garris. I am a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week here in Central Florida to help you change your life with a successful financial plan that provides you with peace of mind for the future. So before we get to those presidential truths, if you will, we wanted to spend some time talking about sort of an interesting phenomenon that is happening out there, particularly with the background of the current political debate. The Democrats, Republicans, President Trump trying to figure out some sort of a stimulus package that will come out to help folks as a result of the end of the extra amount of unemployment. Plus, obviously, there's a lot of other things that are going on in reaction to the COVID pandemic, ranging from being able to pay student loans on time to folks getting evicted and those kinds of things out of their homes. And against that backdrop, you've got a very unique phenomenon happening, because with all of the COVID cases and the lockdowns and the high unemployment and the businesses ultimately really struggling, there was an expectation, and very similar to other previous tough economic periods of time, that you would see things like credit card debt and delinquencies ultimately surge. And, obviously as folks are out of work and having a hard time making ends meet, they would generally borrow. That's sort of been the pattern that we've seen in previous tough periods of time in the economy. But this time, like, the total opposite happened. The credit card debt has in fact fallen since February. Late payments for debt have also fallen, and demand for new borrowing, whether it's credit card applications or even trips to the pawn shop, are down sharply. And so here are the numbers to help put that into perspective. So in the US, the total outstanding credit card debt fell by 11%, or $100 billion between February and the end of June. That's the very sort of peak of all of the lockdowns and all of the shutdowns. April, the month of April, in fact, was the largest single drop on record of credit card debt outstanding, followed by May, which was the second largest. So even the late payments have fallen by about a third. And so what's causing this, of course, is the flood of money that is made its way into the system, whether it be by the Federal Reserve and what they're doing, or by the stimulus packages that the folks in Congress have passed. So, you've got these stimulus checks that came out, you've got this extra unemployment, the extra $600, which stopped at the end of July. You've got the ability to defer mortgages and student loans that came about as a result of the CARES Act. And ultimately, the shift that you're also seeing is a shift to a debit card type of use rather than a credit card type of use. And that's good, because with a debit card, you know you've got the money. If you swipe your debit card, the money's got to be there. If you use your credit card, well, you get the bill in 30 days and hopefully the money's there. So the interesting part of the trend is that debit card usage has been going up. So what's happening is folks have taken sort of the stimulus money and are using it to put themselves in better shape. And if you combine that with the fact that the lockdowns really have restricted people's ability to use money, to spend money, because you can't go anywhere, you can't do anything, then the phenomenon that we're seeing in terms of the actual lowering of the outstanding credit card debt is one that is sort of playing out in Washington in major ways, because we saw this past week where talks to put forth another stimulus bill basically broke down. And then yesterday, Saturday, President Trump signed a series of executive orders. So the question is, what does it all look like? And I guess the important thing is to sort of understand the limitations, right? I mean, the executive branch through executive orders can't make law. That's the division that is in our Constitution. The executive branch, the presidential branch, enforces the laws, and the legislative branch, if you will, makes the laws, and then the judicial interprets it. That's sort of the three classic duties of each of those three branches of government. And so when you make an executive order, it's not the same thing as a law. And so it takes a different type of an approach. And there's really sort of four parts to the executive orders that came out yesterday. And so we're going to talk through each one of them. The reality is that an executive order, again, as we said, isn't a law. So it does take some things off the table. Particularly what it takes off the table is this notion of another round of stimulus checks. Now, that's not to say that the folks in Washington might get together this week or next week and go through this process of ultimately getting a piece of legislation passed. But it's interesting to see this development involving executive orders. And of course, with executive orders comes those limitations. So one of the biggest limitations is that you don't get a second round of a stimulus check. And that was actually one item that the Democrats and Republicans seem to sort of be agreeing on. So we'll see whether that comes to fruition. But as of now, no such deal. And we're left with these executive orders, which may or may not stand legal challenge at the end of the day. So there are four executive orders that we want to really get into and to talk about on the program. And we're going to break those down, but we're going to slide first to a break. And then when we get back from the break, we're going to go into the details on those four executive orders that came out yesterday and how they might materially affect your pocketbook for the weeks and months ahead. All that when we return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So talking about those executive orders that were issued yesterday because of the breakdown in Washington over getting together on another round of a stimulus legislation as a result of the COVID pandemic. And there were basically four pretty wide ranging, so we're going to break them down on the program for you today. Welcome back to Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So, tricky situation, right? Because last I checked the Constitution, it was Congress that could pass laws, and that sort of limits the executive branch, the presidential branch, in terms of what they can do. But we saw a series of executive orders come out of the president's office yesterday in light of the fact that the conversation between the Democrats and Republicans in Congress had sort of really fallen down. And there's really sort of four pieces of the executive orders, or four different executive orders that we wanted to kind of talk through with you. One of the biggest limitations, of course, is executive orders is that they are, after all, that. They're not law. So when it comes to stimulus checks and things like that, which I think everybody was sort of expecting to come out of this round of conversation, that's not able to be done with an executive order. So for now, there's no stimulus checks on the horizon. Stay tuned for future programs, because we'll certainly keep you up to date on that. But this is where things stand right now. So executive order number one had to deal with the unemployment. As of course many of you know, there was an extra $600 of unemployment per week on top of the state unemployment benefit given to folks as a result of the CARES Act. There was a lot of data, a lot of conversation out there that suggested that the $600 was in fact perhaps too much. As much as 70% of the people who were collecting that were actually then making more on unemployment than they were had they been working. And so what that was doing was that was creating a disincentive for folks to come back into the workforce. And so that was sort of a central argument that the Democrats and the Republicans were arguing over, is the Republicans kind of wanted to have that be a lower amount to sort of provide some incentive to get folks back to work. And so executive order number one from President Trump had the extra unemployment restarting at $400 a week. Rather than $600, it was $400 a week. And here's where it gets kind of interesting, because again, it's not a law, it's executive order, so you got to kind of work things around. 75% of that, or $300, is going to come from the feds, and then 25% of that, $100, is going to come from the state. So here's the magic of government accounting. In terms of the federal side, the federal government has something called a disaster relief fund that today has about $70 billion in it. And ultimately, the executive branch, because that is legislation and a fund that's already been set up, the executive branch has control over that. And so what they're doing is they're repurposing about $44 billion of that $70 billion of that particular fund to make way for this extra unemployment benefit. Now, remember, the name of the fund where they're getting this money from is called the Disaster Relief Fund. So that means that it is the government's primary source of money for emergency disasters like hurricanes. So hopefully we have a very smooth hurricane season, because if $44 billion of the $70 billion in that fund is going to get used to pay unemployment, that leaves less for hurricane cleanup, flooding, anything else that might happen of a natural disaster. So I'm not sure how the states are going to react, given that 25% or the 100 of the 400 is sort of in their courts. The reality is that there is expectation that there is in a fund that is already out there, an earlier round of some of the stimulus money, there's an extra remaining $80 billion in that. So the expectation is that the states and local governments will take the $80 billion that remains in that money from an earlier round of aid to help make up their 25%. So again, trying to kind of get some extra in the regular unemployment, trying to repair the fact that that stopped at the end of July, the extra 600, and so the executive order attempts to get an extra 400 into that unemployment through a variety of kind of interesting accounting methods, where you're taking money from other funds and money that was already out there, because it has to be money that's already out there, because again, it's the executive branch, it's not the legislative branch. So an interesting executive order there that ultimately does add $400 to your unemployment check. Next is the executive order dealing with student loans. Basically, in terms of those federally held student loans, federally held, not privately held, federally held is the key distinction there. You're able to suspend the monthly payment until December 31, and the government, again, executive branch, would be able to waive the interest on those loans until then. It basically extends a provision in the CARES Act. It's unclear, really, whether the executive branch has the authority to do this one in particular, but I'm not sure anybody's really going to be the first to step forward and try and sue, given that it's trying to give some flexibility to folks that have student loans and ultimately say, hey, you don't have to make those payments during the COVID pandemic. Similarly, the next executive order had to deal with extending the moratorium on evictions for properties with government-backed mortgages, and that's about a third of renters out there. And how that would sort of work, and again, the enforcement on this is somewhat unclear. It's basically left up to the Housing and Urban Development Department and the Treasury Department to sort of find funds and use existing programs. In a way, you could have the regulators instruct those government-sponsored mortgage corporations, Fannie Mae, Freddie Mac, to offer landlords forbearance on monthly mortgages if the renters had stopped paying, as long as they didn't evict the renters. So there's some things that can be done based upon the regulatory side of things, but again, those are the limitations of the executive actions. The fourth one is the one that I'm sure you're going to hear even more about, and that is the suspension of the payroll tax. And this one is quite tricky, so you really got to kind of pay attention and watch out for the gotcha on this. So just like the extension of the tax filing deadline that is allowed by the Treasury, the Treasury, the tax code gives the authority to the Treasury Department to delay tax filings, to delay collection of taxes after a presidentially declared disaster. So obviously the COVID pandemic, presidentially declared disaster. And so what this one deals with is it deals with the ability to suspend, okay, the collection of those payroll taxes. Remember, payroll taxes are the portion, the 6.2% out of your wage that goes to pay Social Security. So the notion that if you suspend the collection, ultimately you wind up with more in your paycheck. The executive order was limited to income less than $100,000. Whoop. Do I need to call back in then? Tom, can you hear me? Okay, so where do we leave off? Are you running ads or are we live now? Okay, all right, go. So we got a little technical glitch there, still operating from home here and not in studio. So these are the times that they are. And so we apologize for that. So we were talking about the executive order that had to deal with suspension of payroll taxes. Payroll taxes are the 6.2% of the tax that you pay to Social Security. It is within the authority of the executive branch to suspend that because the U.S. Treasury has the ability, when you have a federally declared disaster, presidential disaster, that, or a presidentially declared disaster, let me rephrase that, then you can suspend, and here's the key word, suspend. So the suspension would last from September 1 to December 31. The key word, obviously, there is suspension. It would effectively give people 6.2% more of their paycheck, but it also creates a looming liability for the year 2021 because those taxes would still be due. So There's a political game going on in Congress. The notion is that they would get Congress to then turn around and turn that suspension into an actual tax cut. But who knows whether that would be the case. I think that one is a little bit risky if you're an employee or employer. I'm not sure that you're going to get many employers sort of taking that risk of creating a potential future tax liability for their employees. So that's where it sits for now in Washington. No second stimulus check, no real clarity given the executive orders and not law. But anyway, as we say in radio, stay tuned because we'll have much more of this along the way in updates. We're going to take a break. When we get back, we're going to talk about the 10 truths of presidential elections coming up next here on the program. So as we get closer and closer to the election, certainly our attention is turning in that direction, and it's now less than 3 months away. So today we thought it would be a good opportunity to share with you 10 truths that apply to presidential elections. Underscore this next statement: no matter who wins. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you every Sunday morning on the News Radio WFLA Orlando network, and also now 96.9 The Game. We're also one of the top 25 financial planning podcasts on the World Wide Web, with now over 11,000 downloads of our podcast. My name is Joel Garris. I'm a certified financial planner and certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So, Election Day coming up, November 3rd. Last time, 2016, 138 million people voted. That seems like a lot, but it's only 58%. There's like a whole 100 million other eligible voters that didn't actually vote. So make sure you're doing your civic duty this year and getting out and voting. So what are those 10 truths about presidential elections? Well, these 10 truths actually come to us courtesy of Brian Levitt, who is the global market strategist at Invesco. He did an article recently that we're going to actually post to our social media platforms this coming week, so you can read the full details, see the full charts and things like that of what we're talking about here on the program. But it's got some good stuff, and we certainly wanted to share with it. So here we go, 10 truths. Ready? Number 1, the markets have performed well under both parties. If anybody says that the D's are better, the R's are better, when you look at the pattern, it's a scattergram. You have some presidents that have done well that you would say, oh, I wouldn't have thought that the market would have done well when they were president. There's no pattern at all in any way, shape, or form. And the reality is that oftentimes presidential terms are more defined about what's going on externally, what's going on in the economy, what's going on in the world at large. Those have a tendency to define a presidential term and what happens much more than what actually is being brought to the table in terms of policies or law changes or those kinds of things. It's often the reaction to what has been happening. And in this particular case, I think COVID and the aftermath of COVID, economically, socially, mentally, all of those types of factors will very much come into play and be a big driver of what happens in the next couple of years out of Washington. So markets have performed well under both parties. One party can claim that they're better or worse for the market. Number 2, and this is a truth that exists no matter what, frankly, you're just better off staying fully invested. That's true all the time, but if you took and looked at what a partisan portfolio would have done relative to what being consistent through all parties had done, what you would find is that on a partisan portfolio, so let's say you did a partisan portfolio and you only invested when the Democrats were in power, or you only invested when the Republicans were in power. The underperformance of having that partisan portfolio is substantial versus a bipartisan portfolio where you just stay involved and stay invested no matter who is actually in power. The reality is that when it comes to investing, you should be investing in companies based upon their products and services and goods that they're selling, based upon their earnings as a business, and not really whether, well, wait a minute, this company we think might do better if the Democrats are in office, or this other company over here, it's going to do better if the Republicans are in office. The reality is that a good, well-run company should be able to do well in either environment. And frankly, from an investing perspective, don't you want those good, well-run companies rather than ones that are so connected to the political winds that they only do well during certain environments? I'd rather have something that is much more consistent and has a business model that can be bipartisan in nature. Number 3, as we go through these 10 truths about U.S. presidential elections, and this one is particularly important, a radical re-engineering of the U.S. economy simply does not happen. The U.S. economy is greater than any one political party or any one person sitting in the White House. The ratio of business investment, consumer spending, government spending as a percent of the economy measured by the gross domestic product has been remarkably consistent since the mid-40s. That's a long period, 80 years. The percentages of all of those relative to the economy is pretty consistent. And that's with some big changes along the way if you look at those 80 years, right? In the 60s, you had the establishment of Medicare, Medicaid, right? That was a pretty significant social program. You had big tax changes under Reagan in 1981. You had the welfare reform in 1996 under Clinton, where the notion of working in exchange for welfare, that was the concept that the welfare reform created in 1996. And then similarly, more recently, Obamacare. Those are significant legislative events that many at the time argued, it's going to completely re-engineer the economy. And the reality is that if you look at the composition of the economy and what makes it up in terms of business, consumer, and government spending, there's not really been any significant shift, even with all of those major pieces of legislation occurring along the way. Number 4, your memory fades. And no, I'm not calling you old. The reality is that your memory does fade. The historical narrative is really never quite as you remember it. With Obama, right, everybody was concerned about inflation, yet the environment produced record low inflation. With Trump, the big corporate tax cut was supposed to generate out all of these capital expenditures, but yet even with the big corporate tax cut, capital expenditures have remained well below the historical growth rate. So remember, history often is remembered differently than the actual data. It's important to always kind of maintain perspective on what exactly the actual data is. Number 5, significant legislation is infrequent, and its true impact is often not what was expected. So back to those 2 prior administrations, right? And the healthcare under Obama and the tax cuts, the corporate tax cuts under Trump. So if you remember, when Obamacare was passed, there was a belief that it would destroy small business hiring because now you were going to impose on small businesses the notion that they had to provide health insurance. The reality is that since 2010, 8.6 million jobs have been created in small business through the beginning of this year. And the other reality is that less than 8 months later, after you get this significant legislation, the Democrats were voted out of power. Because remember, the first 2 years of Obama, it was Democrats controlling the House, Democrats controlling the Senate, and Democrats controlling the White House. They managed one significant piece of legislation, that was Obamacare. The reality is 8 months later, out the door, and the Republicans come in. what happened in the Trump administration. Pretty much kind of the same type of sequence. Trump comes in, Republicans have the White House, Republicans have the Senate, Republicans have the House. They get one bill of significance done. That was the corporate tax cut, the Tax Cut and Jobs Act of 2017. And that law accelerated depreciation, increased capital expenditures. And then the other part of the reality is 11 months later, the Democrats came back into power in the House. So it isn't that history lesson from the past, just two presidents, certainly is interesting. You get into power, you pass your signature, if you will, legislation, and then immediately you lose power. That's the real balance and a real testament to our system of government. So that's 5 of the 10 truths about presidential election that apply no matter who wins. Stay tuned with us as we hit the other 5 after the break here on Dollars and Cents with Joel Garris on News Radio WFLA Orlando. Welcome back to the program, ladies and gentlemen. We're talking today about the 10 truths about presidential elections that exist no matter who wins. To recap the first 5 in order of what we gave them. Number 1, markets have performed well under both parties. Number 2, you're better off staying fully invested and not chasing a partisan portfolio. Number 3, a radical re-engineering of the U.S. economy simply doesn't happen, even with some of the legislation that's passed over the past 70-odd years. Number 4, your memory fades. Not an insult that you're getting older, but hey, that's the reality. Your memory fades, and what history says happened is not actually what happened. And then number 5, significant legislation is infrequent and its impact truly unexpected. Ask Obama and Trump what happened after they had full reign, full control over the legislative and executive branch, passed their signature legislation, and then less than 12 months later, in both cases, party in power is swept out, party out of power sweeps in the House. So interesting stuff in terms of what happened. Welcome back to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I am a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week here in Central Florida to help you change your life with a successful financial plan that provides you with peace of mind for the future. So let's get to the other 5, the back half, if you will. This list comes to us courtesy of Brian Levitt, Global Market Strategist at Invesco. It's a much, much fuller article with a lot of charts, graphs, things that don't necessarily lend itself well to radio. So what we're going to do is we're going to put the article up on our social media platforms during the course of this week. So make sure you connect with us on things like Facebook or Twitter or YouTube, or pick your favorite social media channel. Hey, we're on it. And you can see the full article. Got some interesting stuff in there. So on to the back 5. So number 6, here's a shocker. Predictions tend to be wrong. Clearly the future is hard to predict. Past 10 years, just a perfect example, right? You have 2 very different presidents, yet somewhat, if you look at the market, sort of similar market performance, right? Growth and tech leading the way under Obama and also under Trump. Dividend paying value types of stocks lagging, and treasury yields basically hovering around 2.5 or less. And the reality is that Obamacare was supposed to mark the end of the healthcare sector. Well, that's only returned about 15% per year while Obama was in office. So be careful about those types of things where you think you know what's going to happen. The reality is what ultimately happens may very well be very, very different. Number 7, and this one's a big one. Monetary policy matters more. We've been saying this for years now. The reality is that the old expression, don't fight the Fed, is as true now as it ever was. What does that mean? Well, ultimately, the Federal Reserve controls our monetary policy in this country. And what that means is that it's the Federal Reserve that kind of has its foot on the gas or the brake of this great economic engine that is the United States. And so what that means is that when they want to lower rates, then they're putting a little bit more gas. When they want to raise rates or slow the economy down and tap the brakes, then that's when they raise rates. So the Federal Reserve is much more powerful and really the institution that you want to be looking at if you're sort of trying to read the tea leaves as to what might happen in the future. And if you look back at the past several presidencies, you'll sort of see that pattern emerge, right? Reagan and Clinton both benefited from falling rates. Both Bushes got stuck with rising rates. Obama certainly got a better rate environment. And Trump got a tighter policy, but then was able to get the Federal Reserve to kind of start going the other way. So understand that it's monetary policy that really makes a much bigger difference than anything you see on the fiscal side of things. So remember that monetary policy matters more. What's the Fed doing? That'll tell you a lot as to what's going on in the current environment and looking ahead to the immediate term. Number 8, markets don't care if you don't like the president. Now, this one's pretty interesting. If you look at market returns versus presidential approval ratings, you'll find that the strongest market returns actually occur when presidential approval ratings are below 50%. When I saw this number, even I was kind of surprised at how big the gulf is. Let me give you the exact number. So going back 60 years, when the approval rating is in the low range for a president, between 36 and 50%, sound familiar? Sort of what we got right now. You actually had the strongest gains per year, over 15% per annum. When the president was loved, meaning his approval rating was above 65%, that's a well-loved president, the returns were actually much, much weaker, only about 5% per year. So market has a history of sort of generating some of its best returns when the majority of the country doesn't actually, in fact, really like the president. So some interesting numbers when you kind of look at that. Number 9, and this is one that you hear an awful lot about, and that is that this is the most personal, the most vitriolic election, just the worst. To which I say, has anybody seen Hamilton? I mean, you know what Hamilton's about, right? I mean, Hamilton, former U.S. Treasury Secretary, you remember kind of what happened in that? Okay, there was a duel between a guy by the name of Aaron Burr and Hamilton. Well, in case you've forgotten, Aaron Burr, at the time of that duel with Alexander Hamilton, was the sitting vice president. He was the vice president of the United States that got into a duel with the former Treasury Secretary. And, if you haven't seen Hamilton, it doesn't end well for Hamilton. The reality is that so long as Pence isn't taking to the streets to gunfight Pelosi, we're probably doing better, I guess, than what we've seen before. I'll leave you with a couple of quotes, if you will, from some of the founding fathers of what they said about the press. None other than George Washington. He said, "Newspapers are filled with all the invective that disappointment, ignorance of facts, and malicious falsehoods could invent to misrepresent my politics. Not to be outdone, Thomas Jefferson, nothing can now be believed which is seen in a newspaper." Boy, and that. So the truth itself becomes suspicious in news. And lastly, number 10, don't take pundits as objective. A lot of folks saying Obama was going to re-engineer the economy and kill it. Similarly with Trump, the market's going to tank. The reality is the number one thing you want to be focusing on besides the Federal Reserve is you want to focus on earnings. That is the most important part when it comes to your investments. How are these companies doing? How are these companies making money? Are they earning? It is earnings for companies that matter most. Remember, you invest in a company. You don't invest in politics. So when you're looking to determine how best to structure your investments, you want to be looking at earnings, most importantly, not politics. So I hope you found those 10 truths about presidential elections informative. and most importantly, gave you some perspective. Thank you for joining us on the program. We'll get on out of here. That's it for the program here on Dollars and Cents with Joel Garris of Nelson Financial Planning.